Okay. Welcome back, fellow CFA Level 1 Program Curriculum students. Bienvenidos a esta lección de lectura. In today's reading, we're going to be starting financial reporting and analysis. So we have finished professional standards and ethical concerns. We have finished the economic section, and our next major topic is financial reporting and analysis. So study sessions, financial reporting analysis, we have 4 sections. Topic level learning outcomes. The candidate should be able to demonstrate a thorough knowledge of financial reporting procedures and the standards that governs financial reporting disclosures. Emphasis is on basic financial statements and how alternative accounting methods affect these statements and the analysis of them. Financial statements and analysis is critical in assessing a company's overall financial positions and associated risks over time. Security and business evaluations, credit risk assessments and acquisitions due diligence all require an understanding of major financial statements, including general principles and reporting approaches. Because not set in accounting standards has universal acceptance, companies all around the world may differ in reporting treatments based on their jurisdiction. Financial statements analysis requires the ability to analyze a company's reported results, its economic reality, normalize differences in accounting treatment to make valid cross-company comparisons, identify quality issues that may exist in reporting financial statements, and discern evidence of financial statements manipulation by management. Candidates should be familiar with the material covered in the following prerequisite economic reading variables available in candidate resources on CFA Institute website, Financial Reporting Mechanics. Financial Reporting and Analysis, Study Session 6, Financial Reporting and Analysis, Part 1. This study section introduces the principal information sources used to evaluate a company's financial performance, primarily financial statements, income statements, balance sheets, cash flow statements, and statements of changes in equity. In addition, to note these statements and management reporting are examined. A general framework for conducting financial statements analysis is provided. This section also includes a description of roles played by financial reporting standards setting bodies and regulatory authorities. So there's 2 readings in this section. We got reading 21, which is financial statements analysis and introduction. And we have reading 22, financial reporting standards. Firstly, reading 21, financial statement analysis and introduction. Our learning outcomes describes the role of financial reporting and financial statement analysis. Describe the roles of statements of financial positions, statements of comprehension income, statements of changes in equity, and statements of cash flows in evaluating a company's performance and financial positions. Describe the importance of financial statement notes and supplementary information, including disclosures of accounting policies, methods, and estimates. The management commentary describe the objectives of audits and financial statements, the types of audit reports, and the importance of effective internal controls. Identify and describe information sources that analysts use in financial statements analysis besides annual financial statements and supplementary information. Describe the sets and financial statement analysis frameworks. Part 1, introductions. Financial analyst is a process of examining a company's performance in the context of its industry and economic environment in order to arrive at a decision or recommendation. Often, the decisions and recommendations addressed by financial analysts pertain to providing capital to companies, specifically whether to invest in a company's debt or equity securities and at what price. An investor in debt securities is concerned about the company's ability to pay interest and repay the principal lent. An investor in equity securities is an owner with a residential interest in the company and is concerned of the company's ability to pay dividends and a likelihood that the share price will increase. Overall, the central focus of the financial analysis is to evaluate the company's ability to earn a return on its capital in the least equal to the cost of the capital. To profitably grow its operations and generate enough cash to meet obligations, to pursue opportunities. Fundamental financial analysis starts with the information found in the company's financial reports. These financial reports include audit financial statements, additional disclosures required by regulatory authorities, and any accompanying unaudited commentaries by management. Basic financial statement analysis, as presented in this reading, provides a foundation that enables the analyst to better understand information gathered from resources beyond the financial report. This reading is organized as follows. Section 2 discusses the scope of financial statement analysis. Section 3 describes the sources of information used in financial statement analysis, including the primary financial statements, statement of financial positions or balance sheets, statement of comprehensive income, statements of changes in equity, and cash flow statements. Section 4 provides a framework for guiding the financial statement analysis process, a summary of the key points and practice problems in the CFA Institute multiple choice format concludes the readings. Scope of financial statement analysis. The role of financial reporting by companies is to provide information about a company's performance, financial positions, and changes in financial positions that is useful for a wide range of users to make economic decisions. The role of financial statements analysis is to use financial reporting prepared by companies combined with other information to evaluate the past, current, and potential performance of financial positions of a company for the purposes of making investments, credits, and other economic decisions. Yes. In evaluating financial reports, analysts typically have a specific economic decision in mind. Examples of decisions include the following: evaluating an equity investments for inclusion in a portfolio, evaluating a merger or acquisition candidate, evaluating a subsidiary or operating diversion of a parent company, deciding whether to make a venture capital or other private equity investments, determining the creditworthiness of a company in order to decide whether to extend a loan to the company, and if so, what terms to offer, extending credit to the customer, examining compliance with debt covenants or other contractual agreements, assigning a debt rating to a company or bond issue, valuing a security or for making an investment recommendation to others, forecasting future net income and cash flows. Let me drink my drink. Today I am drinking chilled coconut water once again. Honestly, chilled coconut water has been my favorite drink for studying CFA. These decisions demonstrate certain themes in financial analysis in general, and analysts seek to examine the past and current performance and financial positions of a company in order to form expectations about its future performance and financial positions. Analysts are also concerned about factors that affect risk to a company's future performance and financial positions. An examination of financial performance can include an assessment of a company's profitability, the ability to earn a profit for delivering goods and services, and its ability to generate positive cash flow. Profit and cash flows are not equivalent. Profit or loss represents the difference between the prices at which goods or services are provided to customers and the expenses incurred to provide these goods and services. In addition, profit or loss includes other incomes such as investing income or incomes from the sales of items other than goods and services, minus the expenses incurred to earn the income. Overall, profit or loss equals income minus expenses. This is and its recognition is mostly independent from when cash is received or paid. Example 1 illustrates the distinction between profit and cash flows. This is quite elementary. You guys should all know this. Although profitability is important, so is a company's ability to generate positive cash flow. Cash flow is important because ultimately the company needs cash to pay employees, suppliers, and others in order to continue as a going concern. A company that generates positive cash flow from operations has more flexibility in funding needs for investments and taking advantage of attractive business opportunities than an otherwise comparable company without positive operating cash flows. Additionally, a company needs to pay returns to providers of debt and equity capital. Therefore, the expected magnitude of future cash flows is important in valuing corporate securities and in determining the company's ability to meet its obligations. The ability to meet short-term obligations is generally referred to as liquidity, and the ability to meet long-run or long-term obligations is generally referred to as liquidity. And as solvency. Cash flow is a given period is not, however, a complete measure of performance for a period because, as shown in Exhibit 1, a company may be obligated to make future cash payments as a result of a transaction that generates positive cash flows in the current period. Profits may provide useful information about cash flow, past and future, if the transaction in Exhibit 1 will repeat it month after month. The long-term average month cash flow of SD will be equal to 80,000 euros. The monthly profit analysts typically not only evaluate past profitability, but also forecast future profitability. Exhibit 1 shows how news converge of corporate earnings announcements places corporate results in the context of analyst expectations. Panel 1 shows the earnings announcements, and Panel B shows the sample of the news convergence of the announcements. Earnings are also frequently used in analysts and evaluations. For example, an analyst may value shares of a company by comparing the price to earnings ratio to peer companies, and or may use forecasted future earnings as a direct or indirect input into discounted cash flows models of valuation. Okay, so here's just some examples. Major financial statements and other information sources. In order to perform an equity of credit analysis of a company, an analyst collects a great deal of information. The nature of the information collected will vary on the basis of individual decisions to make. But will typically include information about the economy, industry, and company, as well as information about comparable peer companies. Much of the information will likely come from outside the company, such as economic statistics, industry reports, trade publications, and database containing information on competitors. The company itself provides some of the core information for analysis and financial reports, press releases, investor conference calls, and webcasts. Companies prepare financial reports at regular intervals. Financial reports include financial statements with supplemental disclosure necessary to assess a company's financial positions and periodic performances. Financial statements are a result of an accountant. Okay. Financial statements are the result of an accounting record-keeping process that records economic activity of a company following the applicable accounting standards and principles. These statements summarizes the accounting information mainly for users outside the company. Because users of financial information inside the company have direct access to the underlying financial data that are summarized by the financial statements and other information that is collected, because not only are financial reports processes, financial statements are also always audited by independent accountants who provide an opinion on whether the financial statements present fairly the company's performance and financial positions in accordance to the specific applicable sets of accounting standards and principles. Financial statements and supplementary information. A complete set of financial statements includes a statement of financial positions, i.e. a balance sheet, a statement of comprehensive income, i.e. a single statement of comprehensive income and income statement of statements of comprehensive income, a statement of changes in equity, and a statement of cash flow. The balance sheet portrays the company's financial positions at a given point in time. The statement of comprehensive income and statement of cash flows present different aspects of a company's performance over a period of time. The statement of changes in equity provides additional information regarding the changes in company's financial positions. In addition, the company notes or footnotes why financial statements are required and considered an integral part of a complete set of financial statements. Along with the required financial statements, a company typically provides additional information in the financial reports in many jurisdictions. Some or all of the additional information is mandatory by regulators and accounting standard boards. The additional information provided may include a letter from the chairman of the company, a report of management discussion on results, typically called management discussion and analysis, or management commentary, and external auditor's report providing assurance, a government report describing the structure of the company's board of directors. and a corporate responsibility report as part of his or her analysis. The financial analyst should read read and assess these additional information along with the financial statement. The following section describes and illustrates each financial statement and some of the additional information. The balance sheet. The balance sheet, also called the statement of financial positions or statement of financial conditions, presents a company's current financial positions by disclosing the resources the company controls and or so-called assets and its obligations to lenders and other creditors or liabilities at a specific point in time. Owner's equity represents the excess of assets over all liabilities and account in attributes attributable to the company's owners or shareholders. Owner's equity is the owner's residual interest, the company's assets after deducting its liabilities. The relationship among the three parts of the balance sheet, asset, liabilities, and owner's equity, can be expressed in the following equation form: assets equals liabilities plus owner's equity. The equation is sometimes called the accounting equation or the balance sheet equation. Exhibit 3 presents the balance sheet of the Volkswagen Group in the annual report of 2009. So here's the report. In Exhibit 3, the balance sheet is presented with the most recent years in the first column and earlier in the second column. Although it is common to a presentation, analysts should be careful when reading the statements. In some cases, the order may be reversed. The years listed from most distant to most recent. At 30th of December 2009, Volkswagen's total resource or asset worth was 177 billion. The number of sum of non-current assets is 99 billion, and the current asset of 78 billion euros. Total equity was 37 billion. Although Volkswagen does not give a total amount of all its balance sheet liabilities, it can be determined that by adding the non-current and current liabilities, we will get around 140 billion. Referring back to the basic accounting equations, asset equals liabilities plus equity, we will calculate such. Volkswagen, a German-based automobile manufacturer, prepares a financial statement in accordance to the International Financial Reporting Standards, or the IFRS. The IFRS requires companies to present classified balance sheets that shows current and non-current assets and current and non-current liabilities and separate classifications. However, IFRS do not prescribe a particular order or format, and that the order in which a company presents their balance sheet items is largely a function of tradition. As shown, Volkswagen presents current assets before non-current assets before current assets, owner equity before liabilities, and non-current liabilities before current liabilities. This method generally reflects the presentation of the least liquid to most liquid. In other countries, the typical order of presenting may be different. For example, in the United States, Australia, Canada, companies usually present their assets and liabilities from most liquid to least liquid. Cash is typically the first asset shown, and equity is presented after liabilities. As a basis for comparison, Exhibit 4 shows the Walmart Stores Incorporated, or Walmart, from its 2010 annual report. So we can see how, although these both reach the International Financial Reporting Standard, they are different in the format and the order in which the content is presented. I like coconut water. Even though it's December, it's kind of cold, but I still like coconut water when it's chilled. Walmart has total assets of 170 billion, liabilities and non-other equities claim 97 billion. The equity is 72 billion. Later reading will cover analysis of the balance sheets in more depth. This next section describes and illustrates the statement of comprehensive income. Statement of comprehensive income. The statement of comprehensive income under IFRS can be presented as a single statement of comprehensive income, or as two statements or income statements, and a statement of comprehensive income that begins with profit and or losses from the income statement. The Volkswagen Group choose the latter from the presentation rather than a single statement, the income statement. The income statement presents information on the financial results of a company's business activities over a period of time. The income statement communicates how much revenue and other income the company generates during a period, and expenses occurred to generate that revenue and other income. Revenue typically refers to the amount charged for delivery of goods or services in ordinary activity of a business. Other income includes gains which may or may not arise in the ordinary activities of the business. Expenses reflect outflow, depletion of assets and incurrences of liabilities, and decreases equity. Expenses typically include such items as the cost of sales, administrative expenses, and income tax expenses, and may be defined as include losses. Net income, revenue plus other income minus expenses on the income statement, is often referred to as the bottom line because of its proximity to the bottom of the income statement. Net income may be referred to as net earnings, net profit, and profit or loss. In the event that expense exceeds revenues and other income, the result is referred to as a net loss. Income statements are represented or reported on a consolidated basis, meaning that they include the income and expenses of subsidiary companies under the control of the parent or reporting company. The income statement is somewhat referred to as the statement of operations, a profit and loss statement, P&L statement. The basic equations underlying the income statement as revenue plus other incomes minus expenses equals income minus expenses equals net income. In general terms, one company or the parent controls other companies. The subsidiary, the parent company, is owned its own financial statements information considered with that of the subsidiary. Each line item of the considered income statement includes the entire amount from the relevant line item and the subsidiary income statement after removing any intercomplementary transactions. However, if the parent does not own 100% of the subsidiary, it is necessary for the parent to present an allocation of net income to the minority interest. Minority interest, also called non-controlling interest, refers to owners of the remaining shares of the subsidiary that are not owned by the parent. The share of the consolidated net income attributes to minority interest is shown at the bottom of the income statement, along with the net income attributable to stakeholders of the parent company. Exhibit 5 presents the income statement of the Volkswagen Group of the annual report of 2009. Exhibit 9 shows that Volkswagen's sales revenue for the fiscal year ended 31 December 2009 was so much. Subtracting cost of sales from revenue gives gross profit of such. After subtracting operating costs and expenses and adding other operating income, the company's operating profit totals so much. Operating profit represents the result of a company's usual business activities before deducting interest, expenses, or taxes. Operating profit, so-called operating income, is thus often referred to as earnings before interest and tax, or EBIT. Next, operating profit is increased by Volkswagen shares, by the profit generated by certain of the investments, by the profits from the financial activities, and decreased by financial costs. After relocating the losses attributable to minority interest ownership of Volkswagen subsidiary companies and profit attributable to shareholders of Volkswagen for 2009 was 960 million. Allocation to losses of attributable to minority interest ownership results in an allocation to shareholders of the parent company of Volkswagen AG exceeds Net income, profit after tax. Volkswagen disclosure indicates that its minority interest relates primarily to Scania AB, a subsidiary of the Volkswagen owns about 72% of. Companies present both basic and diluted earnings per share for a face of the income statements. Earnings per share numbers represent net income attributable to the class of stakeholders, dividing by the relevant number of shares of stocks outstanding during the period. Basic earnings per share is calculated using the weighted average number of common or ordinary shares, which were actually outstanding during the period, and the profit or loss attributable to the common distribution to the common shareholder. Diluted earnings per share are used to call diluted shares. Makes sense. Volkswagen has two types of shareholders, ordinary and preferred. This presents earnings per share information to both, although there are no requirements to present earnings to share information for preferred shareholders. Volkswagen's basic earnings per ordinary share was 2.38 euros, and a note to the company's financial statement explains that this number was created as follows. An analyst examining the income statement may not make note that Volkswagen was profitable in both years. The company's considerably declined substantially in 2009, primarily because of the lower sales and reduced gross profits. This will not better understand of Volkswagen's profitability, and likely be gained by examining income statements over the long time period. An analyst might formulate questions relating to profitability, such as, in the case change in revenue related to an increase in units sold, an increase in prices, or some combination. If the company has multiple business segments, Volkswagen's segment includes a passenger car, light commercial vehicles, and financial services, among others, and are another segment of revenue and profit changing. How does the company compare with other companies in the industry? Answering such question requires that analysts to gather, analyze, and interpret information from a number of sources, including but not limited to the income statement. Other comprehensive income. Comprehensive income includes all items that impacts owner's equity but are not the result of transactions with shareholders. Some of these income are collected to calculations of net income, and some are included other comprehensive income, OCI. When comprehensive income is presented in two statements, the statement of comprehensive income begins with the profit or loss from the income statement, and then presents the component of the comprehensive income. From Exhibit 6 presents the statement of comprehensive income of Volkswagen Group from the annual period. Statement of changes in cash or changes in equity. The statement of changes in equity, variously called the statement of changes in owner's equity, or statement of changes in shareholders' equity, primarily serves to report changes in owner's investment in the business over time. The basic component of owner's equity and paid in capital to retain earnings. Retained earnings included the cumulative amount of the company's profit and should have been retained in the company. In addition, non-controlling or minority interest, and the revenues that represent accumulated and other comprehensive income items are included in equity. The latter item may be shown separately or include in retaining earnings. Volkswagen concludes reserves as the component of retained earnings. The statement of changes And equity is organized to present for each component of equity the beginning balance, and the increase during the period and decrease during the period, and the ending balance and the ending balance for the paid capital. An example of an increase in new issuance of equity, and an example of decrease is a repurchase of previously issued stocks or stock buybacks. For retained earnings, income is the most common increase in the dividend payment and is most common decrease. Volkswagen's balance sheet in example 3 shows the equity at the end of 2009 totaled so much compared to such in 2008. The company's statement of changes in equity presents additional details on the changes in each line item. Example 7 presents an expert of the statement of changes in equity of the Volkswagen Group from its annual report. In Exhibit 7, the sum of the line item total comprehensive income and deferred taxes equals the amount of total comprehensive income reported in the statement of the comprehensive income, except for rounding differences using the balance of 30th of December 2009. The sum of the columns accumulated profit through the equity accounting investment equals the amount of retained earnings on the budget on the balance sheet, except for a refund for a rounding difference. Cash flow statements. Although income statements and balance sheets provide measures of a company's success in terms of performance and financial positions, cash flows is also vital to a company's long-term success. Disclosing the sources and the uses of cash helps creditors, investors, and other statement users to evaluate the company's liquidity, solvency, and financial flexibility. Financial flexibility is the ability of the company to react and adapt to financial adversities and opportunities. The cash flow statements classifies all cash flows and on companies into 3 categories: operating, investing, and financing. Cash flows are operating activities, and those cash flows are not classified as investing or financial and generally involve the cash effects of transactions that enters into the determination of net income and hence comprise the day-to-day operations of the company. Cash flows from investing activities, also cash flows from activities associated with the acquisition of disposable long-run or long-term assets as the property, equipment, and cash flows and financial activities are those cash flows from the activities related to obtaining or repaying capital to be used in the business. IFRS or the International Financial Reporting Society, I forgot the acronym, permits more flexibility than US GAAP classification, divided and interest receipts and payments within the categories. Exhibit 8 represents Volkswagen's statement of cash flows and the fiscal year ended in December 31st, 2009. The operating activities in sections activity section of Volkswagen's cash flow statements begins with profit before tax, subtract actual income tax payments, and then adjust this amount for the effects of non-cash transactions. Accrual and deferrals and transactions of an investing and financial nature to arrive at the amount of cash generated from the operating activities of this much. This approach to reporting cash flows from operating activities is termed the indirect method. The direct method of reporting cash flows from operating activities describes major classes of gross cash receipts and gross cash payments. Examples of such classes are cash received from customers and cash paid to suppliers and employees. The indirect method emphasizes the different perspective and the income statement and cash flow statements. On the income statement, the income is reported when earned, not necessarily when cash is received. The expenses are reported when incurred, not necessarily when paid. The cash flow statement presents another aspect of performance, the ability of a company to generate cash flow from running its business. Indeed, for an established company, an analyst will like to see that the primary source of cash flows is from operating activities as opposed to investing or financial activities. The sum of the net cash flows from operating, investing, and financial activities, and the effect of exchange rates and cash equals cash equivalents. The sum of net cash flows from operating, investing, and financial activities, and the effect of exchange rates, cash and cash equals the net change in cash during the fiscal year. For Volkswagen, the sum of these four items was such in 2009, which thus increased the company's cash, including amounts held in time deposits, investing from around 9,400 million in the beginning of this period. At the end of this period, as discounted in a note to the financial statements, the time deposit investments of 42 million to 2,304 million of the years of 2008 to 2009, respectively. The note also discloses that, so this is just making sense of the data. Fiscal notes and supplementary schedules. I'm going to drink my coconut water again. The notes that accompany the four financial statements are required as an integral part of the complete set of financial statements. The notes provide information that is essential to understanding the information provided in primary statements. Volkswagen's 2009 financial statements, for example, includes 91 pages of notes. The notes disclose the basis of preparations for the financial statements. For example, Volkswagen discloses in its first note that its fiscal year corresponds to the calendar year, and its fiscal financial statements are prepared in accordance to the IFRS to adopt by the European Union, and the statements are prepared in compliance with German law. That the statements are denominated in millions of euros unless otherwise specified, and that the figures will be rounded, which might give rise to minor discrepancies when figures are added. Volkswagen's also disclosed the financial statements are on consolidated basis, that is, including Volkswagen AG and all subsidiary companies it controls. The note also discloses information about the accounting policies, methods, and estimates used to prepare the financial statements, as will be discussed in later readings for both IFRS and US GAAP. Allow some flexibility in choosing alternative policies and methods when accounting for certain items. The flexibility aims to meet the divergent needs of many businesses and reporting a variety of economic transactions. In addition to differences in accounting policies and methods, differences also arise as a result of investment needed to record the measured transactions, events, and fiscal statement line items. Overall, flexibility in accounting choices is necessary because ideally a company will select these policies, methods, and estimates that only allowable, the most relevant, and that fairly reflects the unique economic environment of a company's business and industry. Flexibility can, however, create challenges for an analyst because the use of different policies, methods, and estimates reduces the comparability across different companies' financial statements. Comparability occurs when different companies' information is measured and reported in a similar manner over time. Comparability helps the analyst identify and analyze the real economic difference across companies rather than differences that arise solely from different accounting choices. Because comparability of financial statements is a critical requirement for objective financial analysis, an analyst should be aware of potential for differences in accounting choices, even when comparing two companies that use the same set of accounting standards. For example, if a company acquires a piece of equipment to use in its operations, accounting standards requires that the cost of the equipment be reported as an expense by allocating the cost less of residual value in a systematic manner over the equipment's useful life. The allocation of cost is called depreciation. Accounting expenses is determined. Two companies may acquire similar equipment but use different methods and assumptions to record the expense over time. An analyst's ability to compare the company's performance is hindered by the differences. Analysts must understand reporting choices in order to make appropriate judgments about when comparing companies' financial statements and performance. On company significant accounting choices must be discussed in the notes to the financial statements. For example, a note containing a summary of significant accounting policies includes how the company recognizes its revenues and depreciates its non-current target assets. Analysts must understand the accounting choices a company makes and determine whether they are similar to those of other companies, identified to the and use the benchmarks are comparable if policies of the companies being compared are different. The analyst also understands accounting and financial reporting can often make necessary adjustments so that the financial statement data used are more comparable. For many companies, the financial notes and supplementary schedules provide explanatory information from every line item or even more than one line, and the balance sheets of income statements illustrates by the notes reference of Volkswagen's balance sheets and the income statement of Exhibit 3 to 5. In addition, notes discloses includes information about the following: financial instruments and risk arising from financial instruments, commitment and contingencies, legal proceedings, related party transactions, subsequent events, business acquisitions and disposals, and operating segment performances. As analysts use a significant amount of judgment in deciding how to incorporate information from note disclosing into the analysis. For example, such information as financial instrument risk, contingencies, and legal proceedings can alert an analyst to risks that can affect the company's financial positions and performance in the future, and that requires monitoring over time. As another example, information about a company's operating segments can be useful as a means to quickly understanding what a company does and how and where it earns money. The operating segment data shows in Exhibit 9 appears in the note of the financial statement of Volkswagen. From the data in Exhibit 9, an analyst can quickly see the most of the company's revenue and operating profit. Profits come from the sales of passenger cars and light commercial vehicles. Over 80% of the company's revenue was generated by the segment in both years. In 2008, the segment accounted for 80% of the company's total segment operating profits, although the percentage declined to 70% in 2009 because of higher sales growth in other two segments. Experience using the disclosures of a company and its competitors typically enhances an analyst's judgments about the relative importance of different disclosures and ways in which they can be helpful. Management commentary or management decision analysis. Publicly held companies typically include a section of their annual report where management discusses a variety of issues of concerns, including the nature of business, past results, and future outlooks. The section refers to as by many names, including management reporting or report, management commentary, operational financial review, and management decisions and analysis. Inclusion of management reporting is recommended by the International Organization, Securities Commission, and frequently required by regulatory authorities such as the U.S. Securities and Exchange Commission, SEC, and the U.K. Financial Reporting Council, FRC. In Germany, many agreements reporting have been required since 1931 and is audited and discussion by management is arguably one of the most useful parts of the company's annual report besides the financial statements themselves. However, other than experts from the financial statements. Additional information included in the management commentary is typically unaudited, which uses information from management reports. And analysts should be aware of whether the information is audited or unaudited. And the management commentary of MD&A is a good string, is a good starting place for understanding information in the financial statements. In particular, the forward-looking disclosures of MD&A, such as those about to planned capital expenditures, new stores openings, or diversities. The management report of the annual report of 2009 Volkswagen includes many information. So here's the example. Here's the audited report. Other sources of information. Okay. So we will continue our CFA level 1 reading on financial reporting in our next section. And I hope my readings have been helpful, and I hope to see you guys next time. Goodbye. Financial statement analysis framework. Analysts work in a variety of positions within the investment management industry. Some are equity analysts whose main objective is to evaluate potential investments in a company's equity securities as a basis for deciding whether a prospective investment is attractive or what an appropriate purchase price might be. Others are credit analysts who evaluate the creditworthiness of a company to decide whether and with what terms a loan should be made or what credit rating should be assigned. Analysts must also involve in a variety of other tasks, such as evaluating the performance of subsidiary companies, evaluating private equity investments, or finding stocks that are overvalued for the purposes of taking a short position. This section presents a generic framework for financial statement analysis that can be used in various tasks. This framework is summarized in Exhibit 11. Articulate the purpose of context of analysis. Prior to undertaking any analysis, it is essential to understand the purpose of this analysis. An understanding of the purpose is particularly important in financial statements analysis because of the numerous available techniques and substantial amounts of data. Some analytical tasks are well defined, in which case articulating the purpose of this analysis requires little decision making by the analyst. For example, a periodic credit review of an investment grade debt portfolio or an equity analyst report on a particular company may be guided by institutional norms such as the purpose of the analyst as is given. Furthermore, the format, procedures, and or sources of information may also be given. For other analytical tasks, articulating the purpose of the analysis requires the analyst to make decisions. The purpose of an analysis guide for the decisions about the approach, the tools, the data sources, the format in which to report the results of the analysis, and the relative importance of different aspects of the analysis. When facing a substantial amount of data, a less experienced analyst may be tempted to just start making calculations and generating financial ratios without considering what is relevant for the decision at hand. It is generally advisable to resist the temptation and thus avoid unnecessary or pointless efforts. Consider the question: if you could have all the calculations and ratios completely instantly, what conclusions would you be able to draw? What questions would you be able to answer? What decisions would your answer support? The analyst should also define the context at this stage, which is intended. Who is the intended audience? What is the end product? For example, a final report explaining conclusions and recommendations. What is the time frame? What is the resources, constraints, and relevant to completion of the analysis? Again, the context may be predefined. Having clarified the purpose and context of the financial statement analysis, this analyst should next compile the specific questions to be answered by the analysis. For example, if the purpose of the financial statement analysis is to compare the historical performance of three companies operating in a particular industry. Specific questions would include the following: what has been the relative growth rate of the companies, and what has been the relative profitability of the companies. Collect data. Next, the analyst obtains the data required to answer the specific question. A key part of this step is obtaining an understanding of the company's business, financial performance, and financial position. For historical analysis, financial statement data alone are adequate in some cases. For example, to screen a large number of alternative companies to find those with a minimum level of profitability, financial statement data alone would be adequate. But to address more in-depth questions such as why and how one company performed better or worse than competitors, additional information will be required. As examples above, to compare the historical performance of two companies in a particular industry, historical financial statements would be sufficient to determine which has faster growth sales or earnings and which was more profitable. However, a broader comparison with overall industry growth and profitability would obviously require industry data. Furthermore, information on the economy and industry is necessary to understand the environment in which the company operates. Analysts often take a top-down approach whereby they gain an understanding of the macroeconomic environments, such as the prospects for growth in the economy and inflation, analyze the prospects of the industry in which the subjects companies, makes sense. To collect data, process data. Process data. After obtaining the requisites, financial statements, and other information, the analyst processes the data, uses appropriate analytical tools. For example, processing the data may involve computing ratios or growth rates, preparing common size financial statements, creating charts, performing a statistical analysis such as regression or Monte Carlo simulations, performing equity valuations, performing sensitivity analysis, or using any other analytical tools or combinations of tools that are available and appropriate for the task. A comprehensive financial analyst at this stage would include the following: reading and evaluating financial statements for each company being analyzed. This includes reading the notes and understanding that accounting towards has been used, which accounting choices have been made, and which operating decisions have been made that affects the reported financial statements. Making any needed adjustments to the financial statements to facilitate comparisons with the unadjusted statement of the subject. Comparison reflects differences in the accounting standards, accounting choices, or operating decisions. Note that commonly used databases do not make such analyst adjustments. Preparing or collecting common-size financial statement data and financial ratios. On the basis of common-size financial statements and financial ratios, analysts can evaluate a company's relative profitability, liquidity, leverage, efficiency, and valuations in relation to past results and or peer results. Analyze, interpret the process data. Once the data have been processed, the next step critical to any analysis is to interpret the output. The answer to the specific financial analysis question is seldom the numerical answer alone. Rather, the answer is to the analytical question relies on the analyst's interpretation of the output and the use of this interpreted output to support a conclusion or recommendation. The answers to be specific analytical questions may themselves achieve the underlying purpose of the analysis, but usually a conclusion or recommendation is required. For example, for an equity analysis may require to buy, hold, or sell decisions or a conclusion about a value of a share of stock in support of the decision. An analyst would cite each information as target values, relative performance, expected future performance given a company's strategic position, quality of management, and whether other information was important in reaching the decision. Development of and communicate conclusion recommendations. Communicating the conclusion or recommendation is an appropriate format in the next step. The appropriate format will vary by analytical task, by institution, and or by audience. For example, an equity analyst's report will typically include the following: component summary of investment conclusion, earnings projections, valuation, business summary, risk, industry, and competitive analysis, historical performance, and forecast. The content of report may also be specified by regulatory agencies and professional standards. For example, the CFA Institute Standard of Practice Handbook indicates standards that must be followed in communicating recommendations according to the handbook section V or 5B. The handbook requires that limitations on the analysis and any risk inherent to the investment be disclosed. Furthermore, the handbook requires that any report includes elements important in the analysis and conclusions so that readers can evaluate the conclusions themselves. 4.6, a follow-up. The process does not end with the report. If any equity investments is made or a credit rating is assigned, periodic review is required to determine the original conclusions and recommendations is still valid. In the case of a rejected investment, follow-up may not be necessary, but may be useful to determine whether the analysis is adequate or should be refined. Summary: the information presented in financial and other reports, including the financial statements, notes, and management commentary, helps the financial analyst to assess a company's performance and financial position. An analyst must be called on the performance of financial analysts and a variety of reasons, including the valuation of equity securities, the assessment of credit risk, and performance of due diligence in an acquisition, and the evaluation of subsidiaries' performance relative to other business units. Major consideration in both equity analysis and credit analysis are evaluating a company's financial positions, its ability to generate profits and cash flows, and its ability to generate future growth profits from its future growth profits and cash flows. This reading has presented an overview of financial statement analysis. Among the major points covered are the following. The primary purpose of financial reporting is to provide information and data about a company's financial positions and performance, including profitability and cash flows. The information presented is financial reports, including the financial statement and notes, and other reports, including management commentary and management's decision and analysis, allowing the financial analyst to assess a company's financial position and performance and trends in the performance. The basic financial statement are statements of financial positions and statements of comprehensive income, the statement of changes in equity, and the statement of cash flows. The balance sheet discloses what resources a company controls and what it owns in a specific point in time. Owner's equity represents the net assets of the company, and the owner's residual interest in the residential claims on the company's asset after deducting its liabilities. The relationship among these three is called the balance sheet. The income statement presents information on the financial results of the company's business activities over a period of time. The income statement communicates how much revenue and other income the company generates during a period, and what expenses, including losses, is incurred in connection with generating the revenue and other income. The basic equation underlying the income statement is revenue plus other expenses minus other income minus expenses equals net income. The statement of comprehensive income includes all the items that changes owners' equity except transactions with owners. Some of these items are included as part of the net income, and some are reported as other comprehensive income or OCIs. The statement of change Changes in equity provides information about increases or decreases in various components of owner's equity. Although the income statement and balance sheet provides measure of a company's success, cash and cash flows are also vital to a company's long-term success. Disclosing the source and uses of cash helps creditors, investors, and other statements users evaluate the company's liquidity, solvency, and financial flexibility. The notes, the company and financial statements are an integral part of these statements and provide information that is essential to understanding the statements. Analysts should evaluate notes, disclosures regarding the use of alternative accounting methods. Evaluate notes, disclosures regarding the use of alternative accounting methods, estimates, and assumptions. In addition to financial statements, a company provides other sources of information that are useful in the financial to the financial analyst. As part of his or her analysis, the financial analyst should read and assess the additional information, particularly the presented in the management commentary. A publicly traded company must have an independent audit performed on its annual financial statements. The auditor's report expresses an opinion on the financial statements and provides some assurance about whether the financial statements fairly present a company's financial positions, performance, and cash flows. In addition to U.S. publicly traded companies, auditors must also express an opinion on the company's internal control system. Information on the economy, industry, and peer companies is also useful in putting the company's financial performance and position in perspective and assessing the company's future. In most cases, information from source apart from the company is crucial to an analyst's effectiveness. The financial statement analysis framework provides steps that can be followed. If the financial statement analysis projected steps are as follows. Okay, so this is reading 21. I do hope my readings have been helpful, and then we will continue to reading 22 on financial reporting standards in our next reading. So see you guys then, and without further ado, goodbye.